In this topic, we move from today's correspondent banking maze to blockchain as a shared settlement layer. You'll build a clear, non-technical mental model of how addresses, wallets, tokens, and consensus can move money across borders in fundamentally new ways. In today's model, every bank runs its own ledger. To move money, they spend time and fees sending messages, reconciling balances, and fixing breaks between those separate databases. Blockchain changes the shape of that problem. Instead of each bank maintaining its own version of the truth, they can share a single settlement ledger. Once a payment is written to that shared ledger, everyone's records update at the same time. Settlement and reconciliation effectively collapse into one step, with instant agreement on balances. On a blockchain, control over value comes down to cryptographic keys. The private key is your signing authority. Possessing it lets you move funds. Losing it is like losing the asset itself. From the private key, the system derives a public key and an address that others can see and verify. The network checks signatures mathematically. No help desk, no password reset, just keys. In traditional payments, routing numbers and account numbers tell banks exactly where to send funds. On-chain, a blockchain address plays that same role, but it's generated using cryptography instead of being assigned by a bank. Your institution controls the private keys. The derived public address is what you share. When value is sent to that address and confirmed on the network, settlement is effectively final, globally visible, and no longer depends on correspondent banks or pre-funded accounts. A blockchain wallet is best thought of as an access card, not a vault. The actual assets always live on the chain. The wallet controls the cryptographic keys that can move them. In a non-custodial setup, your institution holds those keys, so you control security, approvals, and recovery. In a custodial setup, a regulated third party holds the keys for you, trading direct control for operational simplicity and outsourced security and compliance. For institutions, the key objective is removing any single person as a point of failure. Multisig and MPC achieve this by requiring multiple approvals before a transaction can move funds. Think of a 2 of 3 setup where treasury, operations, and compliance each hold part of the control. Any two can approve, but one alone can't. This mirrors familiar dual control processes in banking, while still letting you operate on-chain with strong, policy-driven governance. You can think of a blockchain ledger as having two distinct layers of value. At the base are native tokens, like BTC or ETH. These are built into the protocol and pay for security and block space, much like paying network tolls. On top of that, institutions can issue their own tokens, programmable claims on real-world money, commodities, or securities. For cross-border payments, most innovation happens in this issued layer, but it still relies on native tokens to actually move and settle. When you move money on-chain, you still need something that behaves like familiar fiat. That's where stablecoins and tokenized deposits come in. Asset-backed stablecoins are essentially digital IOUs backed by reserves. Algorithmic models try to hold a peg using code and incentives instead of full reserves. Tokenized deposits are different. They're simply your bank balances represented as tokens on a ledger. Designing on-chain cross-border flows means treating token choice as a strategic decision, not a cosmetic one. Native tokens can offer high speed, but you're exposed to directional effects and market liquidity risk, along with more regulatory uncertainty. USD stablecoins reduce FX risk and keep settlement fast, though their regulatory treatment is still evolving. Tokenized deposits are closest to today's bank money, with low FX risk and strong regulatory comfort, typically within more closed or permissioned networks. Consensus is how a blockchain agrees on the one true ledger, without a central clearer. In proof of work, participants burn electricity and computing power to propose blocks. Attacking the network means outspending everyone else on hardware and energy. In proof of stake, they lock up capital instead. Misbehave, and you lose your stake. Different resource, same goal. Make it extremely expensive to rewrite history, so cross-border payments can rely on a single, immutable record. For finality, the crucial question is, at what exact moment is this cross-border payment truly irreversible? With probabilistic finality, assurance ramps up over time. Each confirmation makes reversal less likely, but never strictly impossible, so operational teams choose a risk threshold and wait. With deterministic finality, there's a clear cutover point. Before that, nothing. After that, it's 100% settled. For institutions, that deterministic flip simplifies SLAs, liquidity planning, and the downstream release of funds. Gas fees behave like tolls on a busy highway. When traffic is light, you pay a low toll and still get through quickly. When it's rush hour, everyone is competing for limited space, so tolls rise. On-chain, it's the same. Transactions compete for space in the next block, and users effectively bid with higher gas prices to get priority. For cross-border payments, this makes routing costs dynamic, driven by real-time network demand. Layer 2 networks are like an express lane built on top of a busy highway. The base chain still provides security and final settlement, but routine traffic is pushed into this faster lane. By aggregating many transactions and settling them on chain in batches, Layer 2 dramatically reduces fees and increases throughput while inheriting the underlying chain's security. For cross-border payments, that means you can keep strong decentralization, yet scale to high volume, low-cost flows that feel essentially instant to end users. An on-chain cross-border payment really boils down to 5 moving parts. First, access. Your institution controls keys, often through an MPC vault, so ops teams can authorize payments safely. Second, the asset. You choose the stablecoin or tokenized money you're actually sending. Third, cost. Gas fees shift with network conditions, so routing and timing matter. Fourth, the network's consensus. This determines ordering and security. Finally, you define when finality is good enough to treat funds as settled.